Welcome to the Options Trader Lounge, and in today's video, we're going to be discussing the recent interest rate decision that took place with the federal government. What we got from this meeting was the Fed announcing that they're cutting interest rate by 0.25%. Now, this wasn't the most surprising move that the Fed has done, as we kind of already knew that was already priced into the stock market. We also saw that the Fed has once again turned back on the money printer. So we're going to be discussing that today, and we're going to be discussing how this may affect you in the stock market. So without further ado, let's get right into it. So once again, the Fed has announced that they are turning back on the money printer. Previously, they've called it quantitative easing, where they're buying treasury bonds. This time around, they're calling it reserve management purchases. And guess what they're buying? Treasury bills. Same exact thing. They're buying their own treasury bills, mainly short-term treasury bills, in order to maintain interest rates lower for longer. And as we know that this is a move that they've done in the past, and so we're going to be discussing how that has affected the stock market. So let's look back here in time. So the first attempt to quantitative easing was a reaction to the financial crisis that happened in 2008. As we see here in October 2007, we saw the peak in the market, and then we saw a collapse that pretty much lasted 521 days. And we saw the market pretty much drop 50%. So if you were invested during this time, you saw your portfolio or your retirement accounts pretty much drop over 50%. And if you're holding individual stocks, you probably even saw bigger drops in your portfolio. So this was very devastating during this time. And people, I would say it would be safe to assume that people thought that the financial system is broken. And if you were in the years of retirement, your retirement portfolios pretty much were cut in half. And so that was very scary to see, I would assume. But that's what happened. And so what did the Fed do? Well, in November 2008 through March 2010, we saw that the Fed turned on the money printer, and guess what happened? The market pretty much bottomed, it found a floor, and then it started to recover. Now, this did not recover to the very top back here in 2007. So several months later, the Fed once again implemented quantitative easing. This is their second round of quantitative easing that happened from November 2010 through June 2011. So this, made boosted the economy or the stock market higher. It did see some volatility that took place, as we could see here several months after their end of quantitative easing. The market took that as a loss that they were probably hoping that it could last much longer, but there was enough money in the economy to keep the market going, which was the whole goal of the Federal Reserve, to maintain markets afloat. And so it did pretty well. It did have a good reaction. And then once again, the Fed announced another their third round of quantitative easing. And so this whole policy shift was their attempt to pretty much maintain and continue growth in the economy. And so this was where we saw this long run up. And so the reasoning for this round of quantitative easing was mainly focused on mortgage-backed securities. And so this attempt here for quantitative easing lasted from August 2012 through October 2014. And so this was an era where we saw continued steady growth. We saw the markets pretty much go up to the right, and all went well. Markets were functioning well. Uh, Banks had enough liquidity in the market until the COVID-19 crash, the 2020 COVID-19 crash. And so the Fed, because the markets pretty much stopped, there was massive unemployments for a short period of time. People didn't, basically, the markets stopped functioning because people didn't go out to spend. Liquidity dried up, and people still had to pay bills. So what did the Fed do? They injected pretty much a doubling of their balance sheet up to 9 trillion. And this was a massive, massive move. And we saw the markets pretty much bottom at the end of this is March. And the markets had a very, very quick recovery, literally a 30% drop, and it recovered only, this is 29 weeks later. We got back to all-time high. And so this was a massive move that we saw in terms of policy change that the Fed had done to inject liquidity back into the market. But this was not without consequences, right? Because as we know, what causes inflation is not necessarily tariffs, as we have seen that tariffs has actually brought prices down in certain areas, but the biggest contributor to inflation is money printing, because when we get more money supply into the economy, there's money floating around and it has to go somewhere. And so where does that end up going? To the pockets of businesses where they could essentially raise prices for the same goods but with more dollars in the system. So we know that printing money causes inflation. And so this was the negative effect of money printing, but necessary because liquidity pretty much stopped on a dime. And so we saw a massive rally um, from this March 2020 low, and we are now up around 200% to where we are now in December, where the Fed has announced once again quantitative easing. Now, they're not calling it quantitative easing, instead, they're calling it reserve management purchases. Now, in the past, quantitative easing, when the Fed has implemented this, they were buying short term treasury bonds. And in this time, in 2025, they're implementing their version of quantitative easing as reserve management purchases. And they're buying the same exact thing, right? They're buying short term treasury bills, typically maturing at 3 years or less. And this is their attempt to flood money into the markets in order to maintain interest rates lower, and their hopes to maintain it lower for longer. And so, what can we take from this whole policy shift that the Fed has done in this most recent change from switching over from quantitative tightening to, you know, to maintain uh, inflation and price stability to now quantitative easing to basically stimulate growth in the economy? So what we can see here is that back at the first attempt was their attempt to prevent collapse in the market, right? And so their first attempt back here in 2008 was really to put a back into the falling economy, right? And basically plug the hole. Now, as we can see here, this was a late response, right? It took nearly a year for the Fed to do something about it. And during that year, we saw people's portfolio pretty much drop, and people's retirement savings were greatly hurt, and the Fed had to do something. But this was a late response, and these the two the two quantitative easing periods that took place after the great financial crisis was a post attempt to this collapse, right? So we saw the markets recover here. So this is a post-attempt policy change. Now we are here in this period where we are practically at all-time high. And so what can we make out of this? Well, as we know in the past, each time they've implemented quantitative easing, we saw the markets rally. They responded well to basically the Fed injecting more money in the economy because it allows businesses to either borrow more so that way they could continue on and grow the economy. Because as we know, with more businesses doing well, we have money circulating through the system. There's no liquidity issues, and businesses can operate smoothly. They can hire more, borrow more to expand research and development, and the markets function smoothly, right? So what we can assume is that with this attempt of reserve management purchases, that we can expect, but it's not 100% certain, that the markets will continue on with its growth trajectory from this point. Now, future future results are not always 100% certain, but we know from the past that whenever the Fed prints money, the markets can typically uh, continue higher. So I think this is a good move that they're doing this ahead of any disasters to come, because as we saw in the past, whenever they acted quickly, the markets pretty much found stability. There was pretty much um, less volatility. But whenever they acted late, whenever something bad happens, you know, you pretty much saw a collapse in the market. So I'm hoping that this time around, with them injecting more money into the economy, it could provide liquidity for businesses to operate smoothly. So that's what I have. Again, we're not in the business of predicting, but if you're trading the market or investing in the market, what you can only do is trade what the markets are showing you at hand, right? So as we can see here, we have the weekly moving averages all pointing upwards in the upper right direction. So that's a good sign that markets are operating healthy. If we move to the daily chart, again, you are seeing the markets move up. You don't see prices below these moving averages or the moving averages pointing down. Because if you are seeing the moving averages pointing down, that could indicate weakness in economy or in stock prices. So that's what I have for you today. So I hope you guys enjoyed this video. If you guys learned something new or got a new perspective on things, that is great. And so if you like this video, please go ahead and like this video, go ahead and subscribe, and we'll see you on the next one. Peace.